Greetings. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC, here with your monthly update for investment strategy. So, a number of indices across the world have been making all-time highs, including the US equities, as well as the FTSE 100, some European equities, the European index, and some Asian equities as well. Asian equity indices as well. And alongside these, U.S. home prices are fairly close to all-time highs. Bitcoin is also near all-time highs, and gold, silver yields on the long end in the U.S., as well as U.S. debt, all at all-time highs. And in the midst of all this, we've got the U.S. president pushing the Fed to cut rates fairly aggressively. So it all comes back to the question of whether US exceptionalism is coming to an end. And so we're going to delve into that in the next couple of slides. So we get to we look at the core data, which is the earnings growth and earnings performance, index performance, and valuation. And starting with the S&P 500, what we find is that the S&P return was 11.1% CAGR price return, of which 7.9% of that was contributed by earnings growth and 3% was from valuation expansion. So not very, mediocre or average earnings growth at best, and a fairly significant 31% contribution from valuation expansion over the period from 2014 to current. Now let's look at the NASDAQ 100 next. With the Nasdaq, the numbers are better. The 17.3% CAGR return on the Nasdaq, of that, 12.8% has been earnings growth, and valuation expansion contributed a fairly significant, again, 24%, or 4.1% of that was valuation expansion, as the valuation of the Nasdaq rose dramatically over the last 10 years. Coming to the Mag 7 is where things get really interesting. 33% earnings growth in the Mag 7 over that same period. Extremely impressive numbers. And the Mag 7's performance was 32.9% CAGR. So the entire earnings growth has been contributed by the Mag 7, which then leads us to conclude that not only is US exceptionalism well in place, and one should ride the trend until evidence to the contrary emerges in terms of any weakness in the models. And much of the contribution and the performance of the US, as we all know, has been largely a function of the leadership technology stocks. Now, just in terms of context, this is the European stock 600. And as one can see, fairly dismal earnings growth at 4.7% earnings CAGR since 2014, and a dismal 4.4% annual return. And that explains why the US remains the most desired market with 61% market cap, even though the economic GDP contribution is much lower. And the same numbers are in the commentary that we share with you for other markets as well. Now, coming to the broader economy, which is not necessarily the market, things remain fairly decent. We're not seeing any signs of credit markets showing any signs of stress. We're continuing to see some key indicators. So we look at consumer discretionary relative to staples. That continues to show healthy trends. We look at the market breadth. That continues to remain largely okay and rising. And we also look at the SOX semiconductor index is participating in the move higher, which is always a good sign. And that was not the case as we headed into the prior correction in 2024. And finally, M2, money supply, one of the three periods where it's rising. This is inverted scale. That typically has also been a positive contributor in terms of equity performance. So things looking decent in terms of the US economy as well. Now coming to India, and there's much more detail in the commentary. So I urge you to take a look at the commentary if you're interested in more details. But coming to India, again, the drop in the repo in the CPI has opened the gates for the RBI to come in and step in and deliver further rate cuts should they deem it necessary, or should the recovery in growth not come through as expected. Now, the data set only goes back, a few years, back to 2012, but the prior time we saw a similar decline in the CPI. The repo rate also came down and was a key reason for the recovery in 2014-15. Coming back to the present, there are signs that the rural economy is doing better. In particular, tractor sales are recovering, and then there's a number of companies that have also reported a pickup in rural consumption that we share the data points on that. And then from an economic activity perspective, light commercial and medium commercial vehicles are fairly highly correlated with a pickup in investment activity. So we're seeing an all-time high in terms of medium commercial vehicle registrations, up 15% year on year, and light commercial similarly up a fairly positive 8.8%. Other very positive data points are in the services and manufacturing surveys, and we're seeing multi-month, 10-month and 14-month highs on manufacturing and services, and very positive commentary coming out both in terms of new orders, in terms of export orders, in terms of cost pressures. Very positive commentary coming out, and clearly evident as both these indices, both these surveys continue to improve. And alongside that, we're also, witnessing continued improvement in the consumer confidence. The expectations index has all improved marginally as well. So consumer remains fairly healthy. Now, lots more again in the commentary. And one of the key points I think at this point, as we wait for the turn in earnings to come through, is that the Indian markets have delivered exceptional returns, and so I've shared the annual returns of the large, mid, small, and micro cap indices in India, and it's we've literally had one year, 2018, where we had some challenging negative returns, and then we've had a couple of years where the markets delivered low single-digit returns. Otherwise, we've had an exceptional performance. One that, in particular, in the last 5 years, the performance delivered by the markets has been stellar, and we make the case that the first 5 years were a time when structural reforms were being implemented. And so for investors that have been patient and ridden out the performance over the last 10 odd years, mid caps have delivered what we would call the holy grail, or close to it, 9x in 11 years. And that's close to almost a doubling of the initial investment every year. And so I think the point we're making is that there are a number of factors that are contributing to growth, and we list a number of industries we believe will contribute to further growth and continued growth as we move forward into the cycle, as well as all of the macro factors that are working in India's favor. Valuations, much has been talked about of late in terms of high valuations. The data says otherwise. The Nifty valuations at around 22 times are basically right at the mean over the last 10 years. India has been an expensive market for the entire Modi regime, and we think that is likely to continue. And so we're not seeing overvaluation on the Nifty 50. And even in the case of mid caps have always been expensive, particularly because of the stellar performance and stellar earnings growth that they have delivered over the years. And so mid caps as well remain barely above the mean average valuation over the last 8 odd years. Now, taking a look at the same data we shared earlier for the US markets, Nifty 50, as one can see, earnings were fairly fairly challenged in the 2018-19 time period, and then there's been an explosion. And so we continue, this is year to date, we continue to see a very good trend in terms of annual earnings growth that is coming through on the Nifty 50. And the valuation contribution has been minimal. So largely the entire earnings growth has been the reason for the move higher in the index. Same for the mid caps. Again, much better, stronger earnings growth other than 2020, and a large acceleration that has occurred in mid cap earnings growth over the last 5 years. We expect that trend to continue. Mid cap earnings are up 3.5x since 2014. And there's been some valuation contribution as well. And like we said, valuations back in 2014, like they were low for the Nasdaq, were also low for the Indian markets. And so there has been a valuation contribution, but valuations remain in line with decadal averages. So that's it. No change in terms of asset allocations. And that's it from our side. Thanks for watching. We'll see you next month.